Hi, this is part 3 in our video series on building a financial model, and it's part of a broader series on valuation analysis as a whole, which we're applying with Chipotle Mexican Grill. Again, standard disclaimer, this is not meant to be a buy, sell, hold recommendation for Chipotle. Things change pretty fast, and by the time you're watching this is probably going to be a little bit dated. So focus on the process, not the actual numbers. Now, in the last video, we went through and talked about some of the key components of the model. We stressed the importance of false precision. This is not going to give you a precise answer. Well, technically it will give you a precise answer, but you need to think of it from a more broader approximation perspective. We have to think about how far out we're going. So again, as you can see, in my model, we have 3 years of historical data, 2017, 18, and 2019. And then we've got several years of projected forecasted data out to 2027. Nothing magical about 2027. You could stop your forecast in 2023. You could carry your forecast out to 2030. However far you feel comfortable forecasting is as far out as you should go. As you carry out more and more years, your precision is going to drop. So the further out you go, the less precise the model is going to be. But there's also a huge error component in developing the terminal value. So that's going to be an issue as well. We talked about how to get the sales forecast numbers because that's kind of the starting point. Your income statement starts with revenues, and your cash flows, which are a key valuation metric, are going to come from starting from the net income. So we need to start with revenues as the baseline for our valuation model. And we talked about some of the many things to consider as you do sales forecasts. You've got to think of what's going on currently in the economy, what's going on in the industry, what's going on in the company, how big is the total market, how fast has their historical growth rate been, how volatile has their growth rate been. Lots of different factors that are going to influence your forecasts for sales growth. Where I want to move on to this video then is forecasting other components of the income statement, because remember, net income is going to be a key component that we're going to need in order to generate our free cash flows. So last time we focused on our revenue forecast. Now let's start to look at some of our expenses. So if we think of Chipotle, remember Chipotle is a quick service Mexican food type company. They sell tacos, they sell burritos, they sell salads, they sell burrito bowls, lots of different things along those lines. And one of the important things for any restaurant is the more of the product they sell, the more cost they're going to have as far as the components of those, which in this case are going to be food, beverage, and packaging. Now that's going to be true for a lot of companies as well. If you're Walmart and you're selling products, the cost of goods sold is going to be a huge component of your cost. If you're Winnebago and you're selling RVs, the cost of building those is going to be a huge part of your costs. Now, it's a little bit different in some areas. So if you look at a company like Microsoft or Salesforce.com or Google, their costs of sales are going to be quite a bit lower because there's not as much of a physical process. If you look at Netflix, their cost of sales, they're going to have those because they're purchasing royalties for existing shows. They're developing their own shows. Those are all going to be there, but they're going to scale differently. So if I'm Chipotle and I sell another burrito, my costs are going to go up on a pretty standard basis. Now, there might be some economies of scale in that, a little bit with food, probably not too dramatic, but it's going to be a lot cheaper for Chipotle to buy the quantity of pork and steak and chicken and rice and things like that than it would be for you or I to buy those. So there are going to be some economies of scale going on there. If you look at a company like Netflix, you're going to have a very different picture, because if they develop a new movie and they have one customer watch that movie, or they have a million customers watch that movie, the cost of developing the movie doesn't change. So they're going to be able to see their cost of goods sold not grow as proportional to sales as some other companies. Chipotle is going to be fairly proportional to sales, and we can see that. So again, let's go back. First of all, let's look at our formula here. We take E2 times forecast of D8. So we're taking our revenues and multiplying that by a percentage of sales basis. So where do we get the percentage of sales? Let's go back and look at historical data. So if I look at Chipotle in 2017, 34.3% of sales. 2018, 32.9% of sales. 2019, 33.1% of sales. Notice you're not seeing 30%, 40%, 25%. You're seeing numbers that basically range from 33% to 34%. If you are going to forecast next year's percentage of sales to be 34%, that would seem reasonable. If you were going to forecast 33%, that would seem reasonable. If you were going to forecast 32%, that might seem reasonable. If you were going to forecast 25%, I'd say, wait a minute, you've got a major problem in your model. If you were going to forecast 40%, again, I don't think that's going to happen. Based on historical data, we can see a fairly narrow range here, and that's probably what you're going to see. You're also not seeing a major trend going on. So here, food, beverage, and packaging costs were a little bit higher. Here, a little bit lower. Bounce back up a little bit. Yes, over the 3-year time period, it's gone down slightly, but over the last year, it's gone back up a little bit. So you've got that to consider, historical data. You also want to look at what's going on within the company. Is there a reason that food costs are going to be rising? So right now, this is early July. Again, I mentioned this in some of the previous videos, but we're in the midst of the COVID-19 global pandemic. And I should stress, because this might be 2, 3, 4 years later that you're watching it, it's July 2020. And one of the challenges that the US has had is a couple of the outbreaks have happened at meat processing facilities. Well, if you're Chipotle, meat is one of your key ingredients. Chicken, beef, pork, all of those are part of your product line. So that's going to maybe affect your food costs. You've got the rice component, you've got stuff for chips, you've got soft drinks. All those things are going to have an impact. And let's say that beef prices rise 10%. And I don't know what beef prices have done over the last 6 months, but just hypothetically, let's say beef prices have risen 10%. Does that mean you should raise this proportion? Answer is not necessarily, because first of all, how much is the total beef cost in one of Chipotle's burritos? Well, maybe you get a steak burrito or a beef barbacoa burrito, and they're actually using beef. It's going to raise the cost a little bit, but is it impacting the cost of the shell? No. Is it impacting the cost of the rice? No. Cheese? No. So lots of other components are going on there. So if beef price go up by 10%, that doesn't mean your food costs are going up by 10%. It's not affecting the cost of chicken. It's not affecting the cost of pork. So we have to think about that. Also, can Chipotle pass on those costs to consumers? Let's say that their food costs rise by 5 cents per item, and they're able to raise their menu prices by 5 cents per item. all of a sudden you're not seeing that big of an impact on percentage of sales. What if food costs rise by 5 cents per item and they're able to pass on a 20% increase or a 20-cent increase in item? So here you have 5 cents higher costs, 20 cents higher revenues. And what that means is this 33% is now actually gone down as a component. So you have to look at how much ability does the company have to raise prices? How sensitive are consumers to those prices? You have to look at what component the cost is. I remember way back many, many decades ago when I was a college undergraduate and we were doing a case study on cereal companies. And one of the things that students jumped on right away because it seemed so obvious is that cereal companies are going to be highly sensitive to grain prices without thinking how much really is the grain cost in a box of cereal. Sure, it's a major ingredient, but what about the packaging? What about delivery? What about the profit? So if grain prices go up by 10%, how much does that really impact the bottom line of Kellogg's or General Mills or any other cereal manufacturer? Probably a lot less than you would think because it's really a relatively small cost of their overall component. Now, does that mean they want grain prices to go up? No, it's still a cost, but it's probably a smaller cost than we might think. So be careful when you say food prices are going up or labor costs are going up. Another issue that might affect this analysis is, remember, this is food, beverage, and packaging. So what's going on with plastic for forks? How are they changing their beverage dispensers? All those things are going to play a part. You can see in my forecast, I just did a simple 33%. That's pretty close to the average. Again, you could argue 33.5, you could argue 32.7. It's going to change the results a little bit, but for the first analysis, this is a reasonable number to go with. Next up, we have labor costs. Now, again, this is an area where you have to be careful because the first thought is, well, I've seen lots in the news about increasing wages, higher minimum wage, the importance of a livable wage. We see companies that need to compete for labor force, and especially in bigger cities where you're going to see more Chipotles, our labor rates are probably a little bit higher. So what's going on there as far as labor costs? And you might think, wow, this is going to be a big pressure on the costs for a fast food company. But is it? And the reason I question how much of an impact it's going to have, and just as a side note, this is something that a couple years ago I was much more concerned about, but probably less concerned right now. The reason for less concern is it's a very labor intensive process in that you need to have cooks there, you need to have cashiers. All those labor costs are going to be important. And if your costs go up by $2 an hour, you were paying people $9 an hour and now you're paying them $11 an hour, that seems like it's going to cut into profits quite a bit. But let's look again at the last 3 years. Labor costs were 26.9%, 27.3%, 26.3%. Not a big difference here. If you were going to say, well, I think labor costs are going to go up to 35% of revenues, no, they're probably not. If you think labor costs are going to go down to 20% of revenues, no, they're probably not. Now, why, if labor costs are going up, is it not going up as a percentage of revenues? Again, Chipotle has the ability to raise prices, and so that's going to offset this a little bit. They also are able to use some technology to reduce the processing. So for example, if I order through an app, I don't necessarily need a cashier. I'm not paying at the counter. I don't need somebody to take my order and then make my food. All I need is somebody to make my food. So technology can help reduce labor costs. We can have economies of scale. I need to have somebody at the counter and I need to have a cashier. I need to have a manager on duty at all times. If my sales go up 10%, do I need to have 10% more people there? Not necessarily. Sometimes I can manage that same level of demand with the same number of, or a higher level of demand with the same number of employees. So these are not going to scale one-to-one with revenues. Now, as you can see, they're scaling reasonably close, but I shouldn't expect this to necessarily say this is going to move in lockstep, or if labor costs go up, this is going to be a higher percentage of sales. So again, looking at historical data, I went with 26.6% and just carried that across the board. Again, you could argue this should be 27%, or this could be 26.2%, whatever you feel is appropriate. But it probably shouldn't be outside of the range of 25 to 28%. And even then, you would probably need a pretty convincing argument if you were going to drop it to 25 or if you were going to raise it to 28. We don't see that kind of variance there. Occupancy costs. This is effectively how much are we spending on our building. So rent, our leases would be a big part of occupancy costs. Now here you can see this went from 7.3% to 7.1% to 6.5%. So a couple of things here you're seeing again. It's a relatively stable number. You're not going to project 2%. You're not going to project 12% going out. You're probably going to want to be somewhere in the, say, 5.8, 5.7 to 8% range. And even again, if you go down to 5.7 or if you go up to 8%, you probably better have a story to tell along with that. Because historically, we're not seeing that. We are seeing a little bit of a decline. However, one of the things that I think is going to be important to think about is as Chipotle opens more and more restaurants, are they probably getting more attractive locations or less attractive locations? Probably a little bit less attractive. But what happens is same store sales go up. So if my restaurant last year did 2 million in sales and now it does 2.2 million in sales, am I paying more for my restaurant? Well, in a lease I might be, but it might not be going up at the same percentage rate as my revenues. So if my revenues go up 10%, my lease goes up 2%, this percentage of sales is going to drop a little bit. So if I can improve same store sales, higher prices, more menu items, more customers coming in, those kinds of things, my occupancy cost is going to drop. The flip side is if for some reason sales growth declines, same store sales decline, this is going to go up a little bit. So project that out. Other operating costs. So you've got other costs of being open. Could be electricity, could be marketing, lots of things going on there. Developing an app is going to have costs. So all of those other costs associated with being in business, and again, 14.5%, 14%, 13.6%, here we're seeing that those have declined a little bit. And if you think about that, let's say building an app is part of this cost. Well, is building an app more of a fixed cost or a variable cost? It's probably more of a fixed cost. You've got the initial build-up cost, but it's not costing you more for every dollar you sell in burritos. Therefore, as a percentage of revenues, it's declining a little bit. Now, if you said, let's jump these to 20% or let's jump these to 10%, again, I'd have a problem with that. But if you're in the 13 to 14% range, that'd be fine. Now, I did something simple. I just kept it flat, but maybe it would be more appropriate here to continue to have it drop a little bit, not a lot, maybe 13.5% 4%, 13.3%, and so on for these costs. It's probably likely that they are going to continue to decline a little bit as we raise sales. General administrative expenses are going to be a part. Again, these appear to be going up slightly. So we've gone from 6.6% to 7.7% to 8.1%. That might be a little concerning. Why are these costs going up? I decided to just keep those at 8.1% going across the board. Again, notice I'm not changing any of these. You definitely can, and you probably should change those based on your analysis of the company. Depreciation and amortization, 3.6%, 4.2%, 3.8%. I went with 4% of sales. Now, this is one that's a little bit tricky because should depreciation and amortization be a percentage of sales or should it be a percentage of assets? You can argue that it should be a percentage of assets. That's what you're depreciating after all. But if you're Chipotle, in order to increase your sales, one of the key components is going to be building new stores. And therefore, your depreciation and amortization is probably going to be closely related to your sales. And you can see that here, that as a percentage of sales, it stayed relatively constant, which would imply that as sales go up, they're going to have a little bit higher depreciation and amortization. I went 4% along there. Again, based on historical data, that seems reasonable. Pre-opening costs. What does it cost to get the store ready for opening? You've got some marketing, you've got building costs, things like that. Those are going to be relatively small for Chipotle as a percentage of sales. And you can see, and they vary a fair amount per year. We've got 0.3%, 1.4%, 0.4%. A little bit more variance here, but this is a really small number. I picked 0.06 and went through there. You could choose a different number, that would be fine. Interest and other income, again, 0.1%, 0.2%, 0.3%. These are small numbers. They're not going to make a big difference in your results, but I plugged something in for that. Tax rate. This is a big one. And why I say this is a big one is if you remember in 2018, we had huge corporate tax cuts. So we had a tax cut act that was passed that changed personal taxes, but more importantly, it also changed corporate tax rates and drastically lowered corporate tax rates. Those were enacted by President Trump. And there is some concern that if we have a new administration come in, those could get changed and we could go back up. Now, I used 22% tax rate. Again, this is a hard number to estimate. What I would recommend is to look through a conference call. Usually they'll provide some guidance. Now, in 2020, a lot of companies are pulling back from guidance based on the COVID-19 pandemic. But that might be something that you think about. And one of the things you might do is a level of sensitivity analysis, and we'll talk about that in more detail as we move through the process, is say, well, that's not going to change in 2020. It's probably not going to change in 2021, but maybe in 2022, we'll see tax rates go back up for corporations. What happens if this is 30% instead of 22%? It's going to impact their net income. And so that's going to have an impact on the model. Now, again, this video is getting relatively long, so I'm going to go ahead and stop here. But that's ultimately how we get to our net income line is we forecast sales, we forecast our various expenses, we set it up in the income statement, and that gives us $341,095, but remember these are in thousands, so you're forecasting $341,095,000 in net income for Chipotle this year using this model. I'm going to go ahead and stop here. We'll have a couple more videos in building the model coming up. Thanks.